Gold, the historic symbol of wealth, elegance, prestige, and most importantly, showing off. This precious metal has captivated humanity for centuries, but beyond its aesthetic appeal, gold has a special place in the world of finance and trading. If you look through YouTube, you'll see many trading gurus claim to teach you how to trade gold. They hop onto TradingView, and just before they're about to teach their amazing strategy, they'll conveniently give you a link for their course, which you can just buy for around $2,000, and then you'll be able to profit a lot of money if you trade gold. Sure. We're going to break things down, and we're going to teach you exactly what you need to be looking for if you're interested in trading gold. Firstly, we need to understand that aside from all the glitz and glory in the financial markets regarding gold, it is primarily considered a safe haven asset. It's something that investors look to buy to protect their wealth when there's volatility in the stock market. Gold, like many commodities, is often quoted in US dollars, so as you can expect, the first thing that you need to take note of is when the dollar increases in strength, this would naturally put downward pressure on the price of gold. But here's where it gets interesting. Like gold, the US dollar itself is also a safe haven asset. So this raises the question, well, if there's volatility in the stock market and money is flowing out of stocks, where is all the money going to? Is it going to go to gold, or is it going to go to the US dollar? This is Paul. He's a savvy investor. He notices that there's volatility coming into the stock market and the S&P 500 is soon likely to plummet. So he wants to protect his capital as much as possible. He knows that if he buys gold, his capital will be safe. After all, gold has been around for centuries and will always be a tradable asset. That being said, gold isn't something that pays a return like dividend-yielding stocks. Paul then notices that the US bond yields are actually pretty high and he can get a decent return. This means that if he cashes out of stocks and buys gold, he won't make a yearly return. But if he buys US government bonds, he will make a decent return of around 5% per annum. So in simple terms, like any investor, Paul's decision regarding whether or not to buy gold will be heavily influenced by the yields that he can get on US government bonds. If government bond yields are high, it would make sense for Paul to take advantage of this and park his money in the US dollar by buying US bonds. If, on the other hand, yields are down, Paul will be more inclined to park his money in gold, even though this safe haven asset doesn't pay a regular return. Now let's look at an example of this on the charts. On the last day of February this year, core PCE results came out. As a result of this, bond yields immediately started to come down, and as you can see, there was a bearish move in the US 10-year yield. On top of this, there was a slight spike in the price of gold, but the move wasn't really that strong. However, it wasn't until the next day, 1st March, when the DXY itself started to come down, and this is where you saw the real move to the upside happening in gold. The price of gold shot up from around $20.50 to new highs of around $2200. As you can see, the downward move in both the US 10-year yield as well as the DXY made the price of gold shoot up and provided a great opportunity to go long on gold. So in summary, there are two important things that you need to take into consideration when trading gold. Firstly, you always want to track the strength of the US dollar via the DXY because, of course, the precious metal is quoted in dollars and has an inverse correlation effect with the dollar. But on top of this, you want to pay very close attention to what's happening in the bond market and yields. If both the US 10-year yield and the DXY are up, this is likely to put downward pressure on the price of gold and vice versa. Thanks for watching. Please hit the like and subscribe button for more content.